So there's a huge controversy brewing around Tom Lee, one of Wall Street's most famous crypto bulls. People are flat out accusing him of being a liar. The claim? That he's on TV predicting this massive crypto boom, while behind the scenes, his own firm is telling its paying clients to brace for a major crash. So what is actually going on here? Is this just a big misunderstanding, or is it something more deceptive? Okay, look at this, because the evidence at the center of this is pretty wild. On one side, you've got Tom Lee's public call for the end of 2026, Bitcoin at a staggering $300,000 and Ethereum at an absolutely mind-blowing $20,000. But then, on the other side, you have a report covering just the first half of 2026 from his own firm's crypto guy, Sean Farrell, and he's calling for Bitcoin to drop to $60,000 and Ethereum to plummet to just $1,800. I mean, these aren't just slightly different takes. They are two completely opposite worlds. And this really gets us to the heart of the matter, doesn't it? You've got one firm, Fundstrat. You've got two of their top analysts. And you have two forecasts that are just worlds apart. So who are you supposed to believe? All right, let's try to get to the bottom of this. We're going to break it all down. First, we're going to look at these two forecasts side by side. Then we'll get into who the players are and where they're coming from. We'll look at the official story from the firm. Then we'll do the most important thing, follow the money to see if their actions match their words. And finally, we'll reach a verdict on what this all means for transparency. Okay, first up, let's really dig into this contradiction. How could two reports from the same exact firm, released just a day apart, tell such completely different stories about where the market is headed? So you've got Tom Lee on camera making this incredibly bullish case. He's not being vague either. He's giving some really aggressive price targets. He thinks Bitcoin will hit 300 grand by the end of 2026, and he's talking about new all-time highs as soon as this January. And for Ethereum, he says it's lights out and could fly past $20,000. That's the story the public is getting. But then, and get this, just one single day later, an internal report from his own firm gets out, and the message could not be more different. The timing here is just, wow. It's this back-to-back contradiction that really poured gasoline on this whole fire. So this report from Sean Farrell, their head of digital assets, lays out a really rough first half for 2026. And what you have to understand is that this was his base case, not his worst case. A base case is what an analyst thinks is most likely to happen. He's predicting Bitcoin down to 60,000, Ethereum at 1,800, Solana at 50. And in response, his model portfolio is shifting a whopping 50% into cash and stablecoins. That's not a little dip. That is a massive, batten down the hatches defensive play. So how in the world does something like this even happen? Well, to get the contradiction, you really have to get the players involved. This isn't just about one guy's opinion. It's about a firm where different people have very different jobs. Let's take a look at who's talking and why. First, there's Tom Lee. He's the head of research. He's the face of the company. His job is to be the macro voice, right? The guy who looks at the big, long-term picture. And his audience? It's the generalist investor, those huge money managers who are maybe dipping their toes in with 1 to 5% of their portfolio in crypto for the long haul. And then you have Sean Farrell, the crypto strategist. He's the specialist. He's deep in the weeds of the crypto market every single day. He's not looking at the 30,000-foot view. His job is all about tactical moves and managing risk for clients who are much, much more heavily invested in crypto. He's the guy navigating the day-to-day storms. So, naturally, this brings us to the firm's official explanation for these two totally clashing views. I mean, is it okay for a firm to have such different opinions under one roof? Or should they have one single clear message for everybody? The official defense, which came from Sean Farrell himself, is that Fundstrat is built this way on purpose. The idea is that the firm has a bunch of different analysts, and each one has their own independent way of looking at things, their own timeframes, all designed to help different kinds of clients. So Tom Lee's long-term macro view is for one group, and Farrell's short-term risk management is for another. And, on the surface, that sounds kind of plausible. But here's where it gets even more complicated. Underneath all those conflicting price targets, the analysts, they actually agree on the fundamental risks. They all see these major headwinds coming in the first half of 2026. A potential government shutdown, tariff drama, a new Fed chair, stress in the bond market. They're all looking at the same storm clouds on the horizon. And this right here is the critical question. If they all see the same risks coming, why is the public message so dramatically different from the private one? Tom Lee talks about headwinds, or the market being choppy and unstable. But does that language really capture an internal forecast for a 50, maybe 70% crash? Come on, that's not a little chop. That's a Category 5 hurricane. The words can be twisted and interpreted a million different ways. So, you know what? Let's forget the words for a minute and let's follow the money. Let's see if the actions of the BMNR fund, which Tom Lee himself chairs, actually line up with his super bullish public statements. So, in the middle of all this controversy, a paying member of Fundstrat Service came out swinging in defense of Lee. They made this really strong claim, saying that BMNR is accelerating purchases rather than slowing them down. Now, if that's true, that's a huge deal. It would mean Lee is putting his money where his mouth is, buying up crypto aggressively just like he's telling everyone else to. But when we look at the actual data, a totally different story starts to emerge. This chart shows how much money was raised each week to buy Ethereum for BMNR. And as you can plainly see, that is not an acceleration. In fact, look at a couple of weeks ago when Ethereum prices were at their lowest, their buying nearly ground to a halt. And to really drive this point home, the most recent week we have data for was the second lowest week of raising capital to buy Ethereum since the fund even started. That is literally the opposite of acceleration. That is a major slowdown. So the big takeaway here is pretty clear. BMR's actions just don't seem to match the message of aggressive, bullish buying. The data shows a serious slowdown, especially when prices were low, exactly when you'd expect a real bull to be buying everything they can get their hands on. Okay, so all of this brings us to our final verdict, because this isn't really about who's right or who's wrong about a price call. This is about something way more important for every single investor out there: transparency. When you just lay it all out, the inconsistencies are just glaring. The public claim the structural lows are in, meaning we've hit the bottom. The reality, the internal forecast says we're going to break those lows. The public claim purchases are accelerating. The reality, the data shows they're slowing to a crawl. The public language is about mild headwinds, while the internal forecast is for a potential 50+% crash. The disconnect is just undeniable. And this just creates a massive problem for investors. You've got conflicting advice from the same firm you're supposed to trust. You have public statements that just don't seem to match what they're doing with their own money. And even worse, there's this basic lack of transparency from the BMNR fund. Investors can't even see simple things like the total number of shares or what the fund's average cost for Ethereum is. And this really gets to the core of it all. You know, when markets are screaming upwards and everyone's making money, it's easy to kind of ignore these things. But the second the market turns, when your portfolio is bleeding red, that lack of basic transparency becomes a huge problem. You can't possibly know what your risk is if you don't have the real data. And so we're left with this really fundamental question. This whole mess just perfectly highlights this constant battle in the world of investing. Tom Lee tells a very compelling, very bullish story. But the data, both from his own firm's private analysis and its actual investment moves, tells a very different one. It forces every investor to ask themselves, in today's market, what's actually more valuable? A great story or cold, hard, transparent data?